All right, so I'm going to try to do this without. All right, so we have two underlying positions that we can implement our option strategy. The first is Fastenal. All right, and so we're going to pull up the option chain here. All right, let's see if I can pull this over. Okay, now I'm going to go ahead and show all of these just for fun here. Okay, now the current price. There we go. Current price is $49.60. Okay. Now, again, this is going to be about cash management. Okay. Again, our software always assumes that we're throwing all of our cash into the market. Let me quickly just show what that really means. Okay. So again, this is the portfolio that we're trying to mirror. Okay. It's the return portfolio. And this is based on doing this as of July 2019. Okay. Now, what we told the software was, hey, we have $4,987.97. What companies do we purchase, and how many shares of each company do we purchase in order to give us the largest return? Okay. Now, what you're looking at here is a percentage of the portfolio. Okay, and this is kind of something that I came up with a while back. This can be changed, but this is what I came up with. It's just kind of an easy way to spread it across the board here. So what happens is the company with the largest score, okay, the largest score for returns, okay, gets the larger percentage of the portfolio. So you see the score percentile here. So this is in the top, 1 percentile. This is 2%, and so forth. Okay, so Best Buy has the best score out of all the companies, and so they get the largest percentage share, okay, of the portfolio. And then we step down to 18%, 15%, 11%, 10%, so on and so forth. Okay. Now, that doesn't really translate into what we do. But again, this is just kind of how that works. So anyway, it assumes that we're going to put all of our money into the market. And you can see here that total cash is $49.87, total invested is $49.85. What that means is if we were to do this, we would have zero cash in our pockets at the end of the day. And the only cash that we would have after that would be whatever cash we get from dividends. Okay, now this particular portfolio is returning something like 8.5% dividend per year, which is really good. So that means that over the course of the year, we'll make, $400 and some to put in our pocket. But that day of July 2019, we wouldn't have any cash at all. And unless someone contributes cash to the partnership, we'll be flat broke, which means if something happens throughout the year, or maybe we need to purchase more shares, something's going on, we won't be able to do so. And so even though, again, this is the portfolio that we're trying to mirror, we have to be cognizant of our cash position. Okay, so one of the ways that we manage that is through our option strategy. Okay, so instead of purchasing 100 shares of Fastenal outright, what we're going to do is we're going to sell a put to purchase Fastenal shares. Okay, now the put that we purchased, I can't get to it right away. See if I can find it. I know it was $55. Let's see. So this is January 15th, February 19th. Okay. Well, just not working for me. I don't remember. I know I didn't go out that far. There's no way. I didn't go out to May. No, I didn't. Anyway, I just wanted to illustrate kind of how this works. So if we wanted to purchase Fastenal at, let's just say, $35, no one is willing to pay us to do that. Okay? Because like I said, right now it's almost $50. So no one's going to pay us to buy it at 35. But we may be able to find someone to pay us to buy it at 47. Okay, and I'm pretty sure this is probably the one I got. So I'll show you how this works. So someone will pay us $40 to buy this stock at $47. And the best part about this is we have until January 15th to do so, which is only like 2 weeks away. Okay, now if January 15th gets here and the stock price does not drop further than $47, nothing happens. We keep our money, and then at that time we can decide to either buy 100 shares of Fastenal or we can just sell another put contract. Okay, so let's click on this one and let's see what it gives us here. Okay, the system is currently unavailable. I think it'll still let us. But yeah, it's not gonna let me do it. Okay, well, anyway, I think you get the point. I think I've illustrated this well enough. So anyway, so January 15th, again, we have the option to purchase this stock at $47. And conversely, we have the option to sell this stock at $52, and someone will pay us $20 to do that. So, again, when January 15th gets here, we can purchase stock at $47. Someone is going to give us $40 to do that. Okay. And then we can, at the same time, sell the stock at $52, and someone will give us $20 to do that. So we're making $60 plus another $500. So $560 for this iron condor strategy. Now, what we're not going to do is we're not going to sell a call until we actually have 100 shares of this particular stock. Okay, we don't want to get in trouble with that. The reason why is because what happens if this stock goes above $52, we're still going to have to sell 100 shares that we don't have. Okay, and I don't want to get caught in a situation where we're shorting a stock, which means that we talked about short interest, right? Where we're selling high and then buying low. I don't want to get into that situation because we can lose a lot of money with that. So we're not going to sell a call until we actually have 100 shares of Fastenal, but we are going to sell a put to purchase shares of Fastenal. We're going to do the same thing with that's right, with Blackstone. Okay, we're going to do the same thing with Blackstone. Okay. Again, instead of purchasing 100 shares outright, and see, Blackstone is a little different. We can go to January 8th, January 15th, January 22nd, January 29th. So we have a lot of options here. So let's just look at January 15th. Currently, the price is about $64. So, and look, this is really cool. You see, we can get paid, and it's all over the place. Look at this. We can get paid $5 to buy the stock at $50. We can get paid $3 to buy it at 47. I mean, this comes down to statistics, and I can show you the numbers on that. just for fun. Let's see if, yeah, let's see if we can pull this up real quick. This is where you can get in and make some money. And we really do uh, have the option of doing that. But again, this is long-term investment, so uh, I'm not going to play around with trading these options. Okay, that's something that I may do in my personal account, but it's not something that we're going to do for Texas Vestments. But I do want to show you how it works. Right then, and let's look at 2 years. Okay, all right. So what we're trying to do is we're trying to predict how much the price is going to move around. Okay. Now, right now we know we're at 65. We came from 50. Okay, and that's the reason why. See, we have some price action at $50 because the statistics will say, and I'm not doing the math on this, we're just looking at this right now, right? The statistics will say very simply that if the price was at 50 not that long ago, it's very possible it'll go back to 50. Okay? What the probability of that is a different thing, but possible. Let's look at the next one. So 55 to 51. See, the next price drop we get is way down here, and I bet you this is sometime in March or April when everything else fell, right? And the price was at 37. So let's see if there's any action up at 37. I don't expect there to be. There's a little bit of action there, so you can make $1, right? If you were to buy it at 37. And see, that's where it's like, listen, there's no way this thing's going to drop to 37. Therefore, that dollar is just free money, you know. All right, let's look at this one here. We got 53 down to 46. It's like $7. And so that's where we have to do a little bit of math. So 7 divided by 53. So what we're doing is we're taking the change in price, okay, we're going to divide it by the price it started at, which was $53. And so it drops 13%, okay? Now we're going to subtract 1, and we're going to multiply that times the current price of 65. That gives us $56. So there's a probability that the price can drop to 56. Let's see what the action is there. $5. If we can make $5, if the price drops below 56, we can buy stock at $56. And again, we only have 2 weeks, so then the question becomes, well, how much does the price move around in 2 weeks, right? Let's take a look at our dates here. And what I'm going to do is I'm going to change this from 1 week. Yeah, I'm going to keep it at 1 week. 1 week, that's 2 weeks. Price didn't move at all, right? Okay. 1 week, 2 weeks. Price moved like $1. 1 week, 2 weeks. Price moved from 55 or 56 to 53. And we can keep doing this. 53 to 52. So that's only $1. And then 53 to 52. So that's like $1. And then 53 to 54 roughly. So that's $1. And then 4 to 55. So it's like $1. So thing isn't really moving around more than like $1. But what is that dollar percentage though? 255. It's about 2%. All right. $65. We're looking at maybe $63, $64, right? In the next 2 weeks, before January 15th, and I can carry out these numbers that we just looked at for the last 3 years if I wanted to, right? But just for illustration purposes, we'll say there's a good chance that the price will drop somewhere between $63 and $64. Now, the price is currently at $65, and someone is willing to pay us $114 to buy this stock at $64 before January 15th. Someone is willing to pay us $77 to buy this stock at $63 before January 15th. Now, as we go out in time, you'll notice that the prices get higher and higher, and people are willing to pay more and more money. And now we're looking at 3 weeks. Now, all of a sudden, we get almost $100 to buy it at 63. Okay, let's go to January 29th. Now someone is willing to give us $104. Okay, now let's go to February 5th. Now, let me talk a little bit about timing and how this works. Now, remember, this portfolio is being updated once a month. Okay, so on January 2nd, I'll come in here and I'll update the portfolio. I'll at least do the accounting. I'll probably initiate that position in Valero, and I'll close out. Well, I can't close out any options, but I won't. So I won't close out the options until February 2nd. Okay. So what that means is that if I do this option we see here for February 5th, it means that I won't be able to close it out until March 2nd. Okay, so that's the reason why a lot of times I'll be looking at stuff like January 29th, because I know once January 29th comes, when I come in here on February 2nd, the option will be closed out and I can initiate a new one. Okay, if I were to sell an option right now for February 5th, I can't come in here and do another option until March 2nd. Okay, so it makes a little bit of a difference, all right, just because of timing and how that stuff works. But you see here, February 5th at $63. Now all of a sudden they're willing to give us $144. Okay, conversely, we can then make another $100 if we sell this thing at 67. Okay, so I want you to understand that we can make 144. And I got to put a calculator to do this. Okay. 144 to buy it at 63. Okay, and then we can make 113 to buy it at. To sell it at 67, but we're also going to make a $400 profit between 63 and 67 when we sell. So that's a total of $657 profit. Now, that's very tempting. We've done it before. It's awesome when it works out. But what that also means is that we have closed out our position in Blackstone as of February 5th, and then we have to, do the analysis again of whether or not we go back into Blackstone, whether we initiate a new position into Bank of America, or maybe even the HIG or the Discovery credit card, right? So that's kind of the bummer when that happens, but we'll also wind up with some orphan shares as well, because we currently have, I believe, 30 shares of Blackstone, and we'll be buying 100, so we'll have 30 extra. But anyway, that's how that works. Again, I'm not going to sell a call until we actually have 100 shares of Blackstone. I'm not going to initiate any new position in Blackstone right away, only because, again, I want to make sure that we're not spending all of our cash. I want to make sure that we keep a little bit in our pocket, specifically because we have to first initiate a new position in Valero, and then I'll be able to see, how much cash we have, We also have the position in Fastenal that we have to initiate that may happen on February 2nd. It may not. I don't know yet. So again, we'll kind of see where we are, and then that'll tell me whether or not to purchase shares in Blackstone and then implement this iron condor strategy from there. That's it for December 2020. I will see you again soon, or you'll hear from me again soon.